All right. For all of you who are tuning in live, we had a great registration for this event. And so this shows the timeliness and importance of updates on the economy. We'll keep doing them. So for those of you who may be getting this recording later or new, just quick introduction here. I'm Kristina Kuprina, the Chief Portfolio Manager and Economist of Sequoia Wealth Advisors. And who I'll introduce in a moment that you see here to my left is John Tousley. Am I saying this correctly?
Tousley.
Tousley, see?
Yeah, yeah. All good.
I read more than I talk. That's a problem. John Tousley from Goldman Sachs. He's a senior strategist at Goldman Sachs. And again, I'm going to introduce him here in just a moment. Couple of quick housekeeping things. Thank you for all that attended our special event on senior fraud and cybersecurity last month. I was on my Peru trip, so Katie Limfeld, our certified financial planner, ran that, and it was very, very well received. For any of you who did not register for that or get the recording, and if you wanted to send to anyone you know that could be vulnerable, could be at risk, friends, neighbors, anything like that, let us know. We'll get you the recording. I cannot tell you how critically important and timely this information is. Being in finance, we're on the front lines of seeing people almost being or actually being defrauded, and it is amazing the sophistication level of some of these things. So definitely we really want to get the word out there, things to watch for and ways to protect yourself. Reach out to us. We will get you a copy of that speaker and that recording. With that being said, as many of you know, I do these kind of updates on the economy webinars about once a month, just to keep everyone updated with what's going on in a fun and interactive fashion, a little different than watching financial news. And so, but you don't always want to hear me. Sometimes you want to hear other people's ideas and other people's thoughts. So many of you have heard us having speakers from Goldman Sachs in the past, and it's been really well received. So today we have John, and he's going to be speaking a bit on Goldman's perspective on the economy, on the markets and whatnot. And as you can imagine, this is a rapidly changing environment. So I do want to stress this is June 2nd, 2026, and this all information could change tomorrow. So again, just to give you where we're at today, and just a little bit about John, just quickly here. I say you have 18 years with the firm, originally in New York, and as we were talking about, has now moved out to Salt Lake City area to enjoy nature and a different environment. John and I have spoken a few times, and I will tell you that Goldman's economic updates and the data they send regularly is a really important part of the information I use when compiling strategy and portfolios. So really valuable information. And today is your opportunity to hear it directly from John. Basically, he's going to speak for about roughly 30 minutes or so, update on the economy, share his slides and everything. Any questions you have, my apologies again for the fact the regulators have taken away our ability to use Q&A and the chat feature in Zoom. So Caitlin is standing by. Any questions you have that you have not already sent in, please send them in through the connect@sequoiawa.com email that you received the invitation from. And I'm going to check in with Caitlin on Slack really quickly after John's done speaking and add any of your questions. Do not have to wait to see if John covers it. Just ask. We can always skip by it, but I want to make sure everyone's questions are answered. And if time permits, I'll fill in any other economic updates towards the end. So with that being said, I'm going to be here. I'm going to turn my camera off so you can see the screen fully with John. And without further ado, let's get to John. Thank
All
you.
right. Yeah, thank you very much, Christina. And I appreciate your disclosures, particularly those about the fluidity of the environment in which we live right now. And as such, as I share a few visuals, you'll find that I'm bouncing around a little bit, and that's just because, normally we have a presentation and it has a shelf life of maybe a few weeks, and we can contain everything in one presentation. And right now, it feels like things have a shelf life of every, a few days. And so hopefully you don't mind the fact that I move around a little bit in the presentation and go from one application to another, but I think it's just going to inform a more useful conversation. So let me start really quickly by sharing my screen. And I want to start with this quote from the U.S. Marine Corps Warfighting Manual. And I want to level set a little bit here. just about it would take a ton of hubris for me to tell you convincingly that we knew exactly how things were going to play out. I think we have a framework, but we are dealing with significant amounts of uncertainty. And so, the quote here, the very nature of war makes certainty impossible. All actions in war will be based on incomplete, inaccurate, or even contradictory information. War is intrinsically unpredictable. At best, we can hope to determine possibilities and probabilities. And I think that we should always recognize it as we're processing information, particularly in a day and age today where being first with news sometimes feels like it's more important than being accurate with news. So we get a lot of false positives and false negatives and or retractions and revisions in what we're processing. So it takes some discipline and it takes some patience to do that. Now, here's the other thing. I'm going to click to this tab, and these are some very famous images, and I want to illustrate a point. If you look at the image on the left, I normally see the rabbit right off. I don't know why, but I always tend to see the rabbit. But if you change your perspective a little bit, it you'll see a duck, or I think it looks a little bit like a seagull. But there's clearly two very distinct interpretations of the visual on the left. The exact same two distinct interpretations can happen on the visual on the right. I typically will see the young woman and sort of her profile looking off to the right. Others, if you will see, this is a young woman's cheek and her ear. If you change your perspective a little bit, you can see that this is actually the bridge of a nose, an eyeball, a mouth, and a chin of an older woman. And so you can sort of visually toggle between both of them. And the reality is there are, again, two very, very distinct takeaways from each of these visuals. The reason I bring that up is if you would let me, I could paint a distinct path to a very resilient economy and markets even going higher than where they are today, and an economy that does, quite well, supported by decent income growth, wealth creation. And on the same token, I could probably illustrate a path to a recession, and that there are vulnerabilities in the economy today that, if are not resolved, could lead to some economic problems. And so, what I would tend to say is it's tempting to look at the economy or look at these visuals and see one outcome or another. The truth is probably somewhere in the middle, and we should consider both observations, but certainly understand that we want to process all of the information and value it all equally. So I say that because I want to I'm going to go to a presentation. This is a system called Bloomberg. It's a robust information system that we use. And I want to go through some charts that tell you two very distinct and different stories. So this is the chart here. The S&P 500, each little dot on the line represents a daily return for the S&P 500 this year. This is a very good looking chart by any stretch of the imagination. In fact, from the bottom, which was the low point here on March 30th, we are up roughly 20%. This right side portion of the chart is a 20% move. The downdraft from the beginning of the year to this low point represents a 7% decline. And so when you net those out, we're up about 12% roughly on a year-to-date basis. Not a bad year whatsoever. We think, and you can see the S&P 500 closing around 7,600 today. We think by the end of the year, we're probably going to be closer to 8,000 on the S&P 500. And so we expect mid-single digit additional returns for the S&P 500. This year, the S&P has hit, as of today, 24 all-time highs. So roughly, and the number of trade, 1 out of every 4 days we've traded, we've set a new all-time high in this market. It's been a very strong market, to be sure. And so again, what has been driving this has been a resilient economy, but exceptional earnings growth. So we just wrapped up the first quarter earnings season. The market expected 12% year over year earnings growth. We got 26%, more than 2x what the market expected. And you might say, well, that isn't that a lot of the hyperscalers and the AI centric companies, the semiconductor companies, just having a temporary explosion in earnings. And there is clearly an element to the AI build out that is really amping up the earnings. But at the same time, the median S&P 500 company, which was expected to grow earnings at 8%, grew earnings at 14%. So if you net all these numbers out, the market up about 12% this year. Earnings are up about 16, 17%. So believe it or not, even with every record we've set this year, the 24 records, the PE multiple on the market has come down. We have paid with earnings for every new high we've had this year. So this is a fundamentally really solid market, rallying on a good economy, rallying on spectacular earnings. Now, that's one vision. We could call this the rabbit version. If I go one slide over, this might be the duck. This is another way to look at the data. This is a chart measuring, going back all the way to the late 70s, consumer sentiment as measured by the University of Michigan. Not only is current consumer sentiment low, it's all-time low. We've never had observations this low. And so our personal accounts, our investment accounts are doing fantastic. But how we feel about the state of everything is incredibly depressed. So you have this huge dichotomy in what's happening to our investments and versus what's happening to our sentiment. Now, there's some reasons that we could argue about this. Now, sentiment, especially in the post-COVID world, as you can see kind of from this peak here moving down, has struggled. There are elements of inflation that have really get into sentiment. There are elements about just the social discourse and our tendency today to politicize everything. And that can be exhausting to sentiment. And we honestly, when it comes to measuring sentiment, can't honestly do a good poll anymore, a representative audience anymore, because simply people don't answer their phones anymore. So we have collection issues, we have inflation issues, we have political issues, all really pulling down how we feel a little bit about the world. And there's no experience more than this chart that impacts how we feel. So the single most influential transaction in our sentiment is our experience at the gas station, paying at the pump. And you can see the immediate rise in gas prices with the engagement in the Middle East. And we've seen a substantial uptick. Now it's rolled over a little bit. I think the market is hopeful that maybe we are closer to some degree of normalization on the Strait of Hormuz. We hope so. But this line is going to stay elevated as long as this next chart stays depressed. And this chart is the number of tankers getting through the Strait of Hormuz. And so we have roughly lost about 10 to 11 million barrels of oil a day. And while we consume about 110, and so we're still populating a lot of the energy needs around the world, just that 10 million barrel a day differential has been very problematic. And so our working expectation is that we will start to see normalization of the Strait of Hormuz almost immediately. And that by the end of June, we should see this line working its way back up to, the neighborhood of 50 or 60 ships. And this is just specifically tankers. This is not even cargo ships through the strait. Now, you might ask, how have we arrived at that framework? And the answer is we know it's a low confidence framework. That again, war is uncertain, but in terms of having to come up with GDP numbers and other numbers I'll go through with you, I just want to level set that our forecasts are based on this line starting to improve relatively quickly. If that line does not improve by the end of June and it bleeds into July or bleeds into August, we're going to make some revisions to be sure. And so we'll get into that. I'll get a little clearer. But this chart here might be one of the most important visuals in terms of how we think about things going forward. So the question is, well, how do you feel? How do you think about things going forward? Let me get to that presentation, and we'll be off to the races. And I'll make it a more full screen view. Um, bear with me. So, in light of that sort of explanation as to how we're feeling about the world, I have this chart on the top, and this is our basic set of views. I have had through the course of the year questions about Venezuela. What does that mean to the markets? Greenland, Cuba, Russia, Ukraine, Iran, and probably more that are going to come. It is a geopolitically complex world. And what I typically do is when we think about things that worry us or make the news cycle, I ask myself, how much does this potential issue impact GDP? How much does it impact inflation? How much does it impact the Federal Reserve? And how much might it impact earnings and therefore the stock market? If these issues have limited impact on those major macro levers, then I'm not sure it's worth all of your energy to worry about. It's a political event, but it's not an economic event. Iran has been one of those events that has moved the numbers. So if I go to this first set of numbers, before the conflict, we expected the economy to grow at about 2.8%. We are now down to 2.1. As I mentioned earlier, if this 2.1 is based on, a relatively normalized traffic pattern through the Strait of Hormuz by the end of June. If that doesn't materialize, then 2.1 is likely to become 1.9. And if it takes till the end of August, then 1.9 is probably going to become 1.6. And so, right now, all of our numbers are sort of on a sliding scale, anchored on the price of oil, and the price of oil is anchored on, can we get normalization of traffic and supply lines repaired? So I would say this is still a good GDP number. It's kind of flat year over year for the US economy. Could be better, will be better if we get resolution relatively quickly. Honestly, could be worse if we don't start to see some freeing up. Now, going to the third set of bars, I'll come back to the employment bar here in a second. But going to the third set of bars, this is core inflation. This is the inflation that the Federal Reserve typically weighs heavily in their decision making. Core inflation before the conflict, we thought would be about 2.1. So we know higher energy prices, raising input costs across the board, raising, your fill ups at the gas station. We now see core inflation at 2.8, so flat year over year, which is a little bit of a bummer in the sense that we were making very good progress on inflation over the last couple of years, and we've now kind of, hit a bit of a wall. Again, if we don't get normalization of the Strait, 2.8 is going to become 3.1. And if it takes longer than July, then 3.1 becomes 3.5. So these are all very fluid numbers. These are based on, again, that original framework. We do think the Federal Reserve may still cut interest rates this year. It's a low confidence view, but it basically is an academic view that current monetary policy is still too restrictive. And as such, the Fed might want to get to a more neutral position. I think the criticism with that view is that maybe monetary policy is where it should be. And because of these inflationary impulses, neutral might actually not be 3%, which is where we think it is. It might be higher. And therefore, the Fed doesn't need to cut interest rates. What I would say regarding Fed policy is it's going to be very much dependent on the data that we've yet to see. These will be game time decisions on the evolution of that data. We think long-term interest rates have probably gotten a little too high. They may come down, but at the end of the day, you're probably not going to see our expectations on long-term interest rates change that much, regardless of the backdrop. And that is mostly because we need higher long-term interest rates to fund our deficit. So higher long-term interest rates, not necessarily a reflection of too much growth or too much inflation. It's a reflection of too much debt. And we have to fund it. 35% of our deficit is funded by global investors. We need to maintain attractive interest rates. And many investors feel like our dollar will weaken when the world stabilizes. And so we need higher interest rates to also fund some of that dollar weakness. And then the last set of bars, and I've already talked about equities. I think we're in a very ideal sweet spot with earnings growth that will persist for a few more years. So we like the potentiality of equities to continue to move higher. I'm going to say things very, very simply. If I've got 2% growth and I have double-digit earnings growth, history tells us it almost doesn't matter what's going on around the world. Your equities are going to be in good shape. So my first set of bars and my second set of bars are probably more important to where equities go than the headlines we see every morning on the geopolitical backdrop or on midterm elections or whatever issue you have. And so I really, to be honest, as much as we've had a good run, I'd be nervous to pick a fight with the economy and earnings right now. They've got too much momentum. That doesn't mean we don't worry about things, but certainly those are two very, very favorable tailwinds. Now, I'm going to talk about two areas that we will watch where we would, well, kind of two additional areas where we would change our views, and these are risks to our view. So the first one, and so there'll be a total of three. The first one is the Strait of Hormuz. Again, cannot emphasize enough how important getting that normalized is. The next issue is the labor market. And I'm going to move a couple charts so we get to the labor market visual. And these are a little, maybe a little tricky visuals, but we are, what I would say in the labor market, healthy but vulnerable. The analogy I would use is the labor market right now is at the edge of a cliff. You could stay right where we are and be just fine, but that next step forward could be very punitive for the labor market. And the reason I say that is if you look at the chart on the left, this is what is known as the beverage curve. And the beverage curve measures on the y-axis the number of job openings. So just think about it as help wanteds. How many help wanteds are out there? And the x-axis here is the unemployment rate. And so when we came out of COVID, we were way up here in the chart, meaning there were vastly more job openings than there were people looking for work. To put the numbers in some context for you, we had 10 million people looking for jobs. There were 16 million jobs to choose from. So the market was really tight, help wanted signs everywhere. Today, the light blue line, we're right here kind of in the inflection point. And in fact, we got the JOLTS report today on the labor market, which is the data we used to build this chart. And we're now at the point that rather than having 6 million extra jobs to choose from, we now have technically about 250,000 people more looking for work than we have job listings. So the labor market's become really tight. If you have a job, you're probably in decent shape. If you are looking for a job, it might take quite a while to find that job. And so that's where we find ourselves right here in the inflection point. We could stay right where we are and be fine. That's pretty much what we think is going to happen. But if there was something that would, in addition, would disrupt labor market demand, the only place this dot can now start to go is to the right, which means a higher unemployment rate. And if I have a higher unemployment rate, then I worry about people losing their jobs. And if people start losing their jobs, then I worry about uh, consumer spending. And if consumer spending falls off, I know earnings are going down. And if earnings are going down, then I get more layoffs. And dang it, we're in this virtual or not virtuous, this negative feedback loop. And so we were going to watch Strait of Hormuz, number one. We're going to watch the progress of the labor market because we're in good shape, but we're vulnerable. And if we start moving along this x-axis, that could become a self-feeding mechanism. Now, one other point I want to make is that the third risk we watch, and this is an interesting visual here with 6 columns, and this is 100 years worth of recessions. And then, Kristina, I'll come to you in about 2 to 3 minutes. Um, what we do is we mark a box.
Interrupt you for a moment. And
Yeah.
I would say that I've already gotten questions on some of the slides you didn't cover. So I'll come back to you after you're done with maybe going back to some of
Yeah,
this.
there's like 35 pages in this deck. There's lots I haven't covered, so we're happy to go through that.
Okay.
Um, the third thing that we watch when we're looking at the state and the health of an economy is financial bubbles. And so what has happened over the last 100 years is we used to have recessions, and they were industrial cyclical recessions, or in this case, fiscal means war. This is not legislation, this is wartime. So in 1918, we had World War I and we had the Spanish flu. And those two factors were major contributors to a global economic downturn. And what you see is we used to have wartime industrial oriented downturns. And over time, we have become much more of a monetary and financial economy. We're a financial and services economy today, which means we don't have recessions as frequently. They're likely not as deep as prior recessions that we'd go through. And yeah, we can go 10, 12, 15 years between recessions. And so when we're thinking about risks to the economy, we don't really worry about the industrial cycle anymore. We worry more about, do I have asset bubbles? And this is a complex chart here. I won't unpack it, but the major takeaway here is that our private sector is in good shape. Our banking system is in fantastic shape. Our corporate debt levels are in great shape. My consumer FICO scores and balance sheets have been improved. And my problems in today's economy aren't financial. The two things I would highlight that give us notice is I have a lot of government debt, and at some point that's going to rear its ugly head. But we have no near or intermediate term alternative to a dollar and a treasury. So the renminbi or the euro are just not in a position to replace the dollar as reserve status. And so we can run our large deficits for quite some time before we have that clearing moment for the market. And then the dot here highlights equity valuation. We are high on valuation. And I'm going to wrap up with this really important point. You can have high valuation and fair value at the same time. So the chart here measures next 12-month forward multiples. The dark blue line is the forward multiple. And people said earlier in the year, your multiple is similar to where we were in the dot-com bubble. Are we not concerned that we are feeling dot-com-ish? And the answer is not really. Not because we're ignoring obvious issues, but because every year we kick out 4% of the S&P 500 and replace it with better, more profitable, less cyclical companies. In fact, every decade, 40% of the S&P 500 is like gone. And so when I look at this line, yes, we are historically expensive, but there are only 192 companies at this peak right here that were even in the S&P 500. We have changed the composition of the S&P 500. The S&P 500, to be honest, doesn't even look like the economy right now. And I sat there and argued how good the economy was, and the S&P 500 could do really well in a very mediocre economy. So what we do is we look at the light blue line, and the light blue line is the model that says, well, what's fair value? interest rates, GDP, profitability, revenues, sector composition, all the things that get baked into how do you value a stock market. And right now, the models would say the fair value for the stock market's 22 times. We're currently at 21. So what I would suggest is you can be historically expensive and fairly valued at the same time. And that is an important takeaway for investors. We're going to watch Strait of Hormuz. We're going to watch what's going on with labor. We're going to watch for financial bubbles. We are very comfortable with the backdrop of financial risk right now, and think we have met significant time between valuation and government deficits become a problem. So with that, Kristina, let me turn it back to you. Happy to go through questions or slides that I breezed through.
Sure. Actually, because there are so many questions and they continue to come about AI and the job market. Is AI going to take everybody's job? What will happen? There's a lot of fear. And I
Yeah.
think maybe because we're headquartered in Silicon Valley, it's even really more visceral. I've noticed you
Mhm.
had some charts on that. And so before we head into questions, if you don't mind talking a little bit about that.
Yeah. So let's just start again with the premise that there has been more um, change in large language models and in AI in the last 4 months than really even in the last 3 to 4 years. Like we are hitting escape velocity in terms of the rate of change of things. And so um, I don't know, it's hard to be precise about where these lines of demarcation and impact are going to happen. There's no doubt the technology is world altering, but there is a lot of doubt about how well we can monetize it. And, is this spend by the hyperscalers going to pay off? And so lots of moving parts about the investment side, the enterprise side. But when we think about labor, the chart on the left, the pie chart here, is our basic framework. And it looks at all kinds of technological innovations that we have seen in the past that transformed society, including the discovery of oil in Pennsylvania, the synthesis of nitrogen into fertilizer, the steam engine, the electrical motor, the automotive industry, the internet, the PC computer. We have all kinds of examples of seminal moments in technology. We think this is going to be one of the top three ever. And we would say that about 7% of existing jobs are likely to be replaced over the next 10 years. Right now, 2.5% of jobs right now today could probably be replaced with AI. And as you said, Kristina, many of these are localized in Silicon Valley. So when we look at the layoffs that we've seen, it's very focused in IT, very much in operations, data labeling, software development, and customer support. So it is not economy wide. It is very focused, and obviously you have significant exposure to that in your community. 63% of jobs we think will be augmented. And so roughly 25% of tasks economy wide can be replaced by AI. Not 25% of jobs, but 25% of tasks. And I know that I'm, at least 25% of what I do, it can really, really be enhanced by AI, minimum. Um, what I would say is when we look at this and we look at history, we believe that you get more job creation and more specialization because of technological innovation than you get job replacement. But job replacement often hits earlier than job creation. And so when you look at this chart on the bottom, these are the layoff announcements monthly. And the dark blue bars would be the portion of the layoff announcements that can be attributed to AI replacement. So it's still running only about 5% of job replacement. Our layoffs are generally quite low, And of those layoffs, only 5% are AI related. Most of the layoffs are coming from companies, the Verizons, the FedExes, the UPSs, the Amazons of the world that overhired during COVID. So I'm going to go to this next slide here. Okay. And I want to give a couple examples. And I actually, just interestingly enough, on the bottom left, my wife last night had an emergency appendectomy. And we went to the hospital and we were home in 3.5 hours, 4 hours. And she's bouncing around like it didn't even happen today. That's not what would happen with an emergency appendectomy 30 years ago. And I look at this chart on the bottom left, and I think it's a really good example of what happens. AI is going to replace skills, it's going to replace tasks, it is going to drive specialization and expertise. And so back in the 30s, 40s, and 50s, there were not many jobs in the medical field that were specialized. They were almost all the jobs were generalists. But as we've learned more about chemistry, the body, physiology, psychology, now you use your GP almost entirely for a referral source to deal exclusively with specialists. There's 1,500 specialists in the medical industry, and this all is born out of technology and very few generalists. I look at the top chart, and I mentioned, Amazon. We've seen in the last 15 years a complete transformation of the retail industry. And retail jobs, the dark blue line, have moved lower. We've lost about in this little period here, we lost about 370,000 retail jobs between 2017 and 2020. Those jobs evolved and rotated into transportation and warehousing, where we created almost 800,000 jobs. There's literally about 400,000 more jobs as technology went into the retail and the warehousing industry. Chart on the right highlights that while we're starting to see pressure in certain areas of the market, if you have good hand-eye coordination and good technical expertise in plumbing and electrical and utility, like we are literally 500,000 electricians short of where we need to be to build out the AI infrastructure over the next 10 years. And so you're seeing explosion in demand in other areas, and in globally, AI capabilities is, probably the most requested feature right now. And so what I would suggest is, like, I can't say exactly how this is going to play out, but we have lots of evidence that there will be a little bit of a J curve and maybe slightly more job losses in the early phase of AI, but ultimately significantly more augmentation and specialization in every industry because of AI. Um, and I know I've been long-winded on this answer, Kristina, but I want to make one really important point. I'm biased on this, and so take what I say with a grain of salt. But I have my, over the dinner table, we have discussions about AI and data centers, and I have members of my own family that believe that data centers and AI are going to transform the world in an incredibly negative way. I tend to believe AI and data centers are going to save the world. I think AI is the path to the 4-day work week and then the path to the 3-day work week. I think AI, if we do this right, the productivity gets split. Company maybe gets half of it, and we personally get the other half. And all I can say is every Friday, I used to be in a 3 to 4 hour editorial board to review all of our research. AI now does that. And so those 3 to 4 hours in an editorial board now largely accrue to me. I know Goldman thinks they're getting that time, but I'm out like you, Kristina, enjoying the world. And I think a happy me is a happy Goldman Sachs. And so I'm really, really hopeful that if we do this right, there is a lot of productivity that will accrue to us personally, and that we will find greater satisfaction in everything we do because of it. So I might be a little bit Pollyanna at this point, but that's what I hope is ultimately going to play out here.
Well, I want to thank you. Stay on because we have some questions. To add to that, thank you for the showing and the sharing of this information. I am also someone I've heard all the sides of any time there's technological innovation. And one thing that's absolutely fascinating to do is to read the responses to any other technological innovation in our history. Railroads, automobiles, some of the things you talked about. And there was always the doomsayers that it's the end of the world, everything's going to just be destroyed, all these bad things will happen. I remember automobiles were supposed to rip your face off. If you got into an automobile, your face, skin off would be ripped off your face. And women would never be able to have babies if they were around electricity. So there's always that because it's new, it's unknown, and there's always different opinions about it. Nowadays, especially as you mentioned, news is like get something out there, get a lot of eyeballs, get attention, get hits, and you can pretty much say anything. And we are naturally, designed. Our brains are naturally designed to protect us. So it's new, it's scary, it's harmful. Protect, protect. And to see the fact that, well, nobody truly knows the outcome of this if used properly and used well. I can speak a little bit about how we do things at Sequoia. Anything that we do that increases productivity buys our team more time to train, to learn, or to take a longer break, to not have to do busy work. We're obviously very restricted by regulations how we use things and can't in any way use it anything to do with clients or client data or client information, but we can use it for other systems and processes within our organization. And there were certainly concerns with our team that, we've actually hired a lot of new people over the last couple of years, right? Because we've grown so much as a firm. And I said, no, if you can find more productive ways to do things, go take a longer break, walk your dog, take off earlier on Friday.
Yeah.
And so I do see that world where you can have that. It's productivity rather than hours worked. A 40-hour work week is a union creation. And it was created in a time when there was no guarantees or protections for workers, right? 12-hour days, 7 days a week, didn't matter. But it doesn't mean that has to be the future. We could
Yeah.
have just as productive workers earning the same amount of money and working less hours, which for quality of life is huge. I also love the commentary that you made about your wife. I'm really excited that we still got you today because you could have been sitting in a hospital with her. And the technological innovation with AI, the turnaround time for new medical breakthroughs. And a lot of this is really fascinating to see how much more quickly testing can be done. And as someone who's a great lover of animals, the idea that animal testing could be completely eliminated through technology would be
Oh,
a
yeah.
very joyous moment for me, but with no impact, and if not even better impact to human outcomes. So there's a lot of optimism and a lot of excitement, and it just like anything else, it just depends on how you choose to see the world. None of us know. Focus on the outcome you wish to see rather than a fear-based, because it'll be a miserable next few years as we go through this transition. If so, I hope that was okay. I was a little bit on my soapbox there. I get on the soapbox for two reasons. Number one, to always show there's a lot of different ways to see the world and things that are happening. And the other one is that chart that you showed when you consumer sentiment in relation to the economic data has and you, as you correctly pointed out, has been going on since the pandemic. Something fundamentally shifted in society, in societal thinking, and since the pandemic through two different political administrations, so it's not a political direct thing. Something during the pandemic really, really changed where there's been this disconnect. And anything that I can do to help bring more optimism and different ways of thinking to people that helps them be happier mentally, physically, emotionally, spiritually is a very meaningful thing to me. So I really thank you for sharing this information in a much more sophisticated way than I usually do with people to be able to see there's different ways to see things. I want to be mindful on time, so I'm going to kind of put out I kind of consolidated all these questions and new ones that came in sort of together. And I think you really touched upon this well. I'll help you answer the question, and I may or may not add to it. But you did touch upon it. I know it a lot is tying to the outcome of the war in Iran, one of those wars. Anyway, that being said, the war in Iran, what happens in Strait of Hormuz, and the importance of that with a lot of these projections and the ongoing uncertainty there, because it seems like the news every day, it's like, we're almost there. Oh, not quite. The administration in Iran is very unstable, and this could be a longer process than many probably hoped. But that being said, a few questions here came around. What is your outlook for inflation? with and without the war. I think you already touched upon with the war, like if it kept going on, kind of how it was sort of increasing some or decreasing some of the projections, but maybe talk a little bit more about the outlook for inflation, maybe high
Yeah,
level.
let me in fact the the chart here on the left is a really good way to think about it. You can see the path for inflation as we went through and came out of COVID. It exploded, and there's a lot of debate about inflation where we go. We're not going to achieve any of the levels that we saw coming out of COVID. There's three lines here, and I think there's a couple takeaways. The light blue line is the underlying trend of inflation. So wages, rents, housing costs, healthcare costs, things like that. Then we add a couple other lines, which is, well, in light of tariffs, I get this intermediate line. And then in light of tariffs plus energy inflation, I get this darker blue line. The point being is there's a lot of ways to perceive what's going on with inflation. But what's interesting is that tariff inflation and supply disruption are definitionally temporary. And so they will roll out of the calculations relatively quickly. And so the one thing we can't really debate is that by the end of this year and into next year, all three lines will converge. I think that'll allow our central bank, all of the voting members, to get on the same page. Right now, we have a lot of dissents because some members want to follow the light blue line, others want to follow the other, and they're all debating which line's the right one to track. And by the end of the year, they're all sort of going to be in the same place. So, rate of change of inflation is what we measure here. Now, if we don't open the straight, my dashed dark blue line is going to push out here. It's so I can't pretend I know exactly, but we're going to see more inflation what I'm currently modeling here. Here, I think is the problem. And again, this gets to the sentiment issue, the chart on the right. We were on about a 1.5% inflation rate trajectory before COVID, and that's the dashed line. Had we stayed on that trajectory, we'd be on this light blue dashed line. Since COVID, we've exploded. So this is price level. So even though on the chart on the left, I can say year over year inflation is most assuredly going to be better this time next year. What I can't tell you is that prices are coming down. What I can just tell you is I think they're going to go up less quickly. I think this has huge sentiment implications. I think it has huge political implications. It doesn't matter who created the inflation. It does matter who's in office when you're voting on inflation. And so at the end of the day, I think this is going to probably be more of a political event and maybe an event for central bankers to have to think about. But we have departed significantly. There's not a transaction anybody makes. You go out to dinner and you're like, no one's ever looking at the bill and being like, oh, that wasn't as bad as I thought. It's always that was worse than I was expecting. Gas prices are worse than you're expecting. And so we're in this chronic scenario where we're being reminded with almost every single transaction how much more expensive things have become. And that is an issue that's not going to resolve itself anytime soon. By the way, the way you get these lines to come back together is you earn your way. You need wages to pick up and start to narrow this gap. That's the best way to do it, is through wages.
Well, the alternative is a recession, so we'll take the rising wages.
Yeah, totally. Yeah, yeah, to be sure. Yeah.
And I think that's a really, really great chart to show because a lot of times people say, the official inflation number, CPI, it's like 2.7, wherever we're at any given time. And they're like, oh, no way. That's not the real number. Like your
Yeah.
example, I just went out to eat. I just paid my electric bill. And in California, the PG&E bill, Northern California's utility, has doubled in the last 4 or 5 years, doubled. And that's what people see. So they don't really believe the 2 point something percent number. And I think your chart defined it perfectly.
Yeah.
There's a lot of reasons that costs go up, and some are transitory and some are cumulative. And it's not just something that will be solved by a change in administration or a change in policy or a change in this. There's so many factors that input into prices.
I
As
think you, and I think you raise a really interesting point for the listeners today, which is you're never going to feel like inflation is being reported correctly. And the reason is that inflation is a basket of things. Like CPI is literally just a basket, car payments, home payments, food costs, all these things. And the basket never changes. And they just measure the price of these things, um, over time. Well, the reality is as a consumer, if prices get expensive, you change your spending habits, you change your basket. Number two, your basket, if you're older, is totally different than someone's basket who is younger. And so it's very rare that what the government is measuring is a
Mhm.
reflection of how you're actually spending. And so don't ever hope that you're going to see an inflation report and be like, oh yeah, that seems about right. It'll never feel right.
That's a really good example. Even when we had you showing this period of very low inflation, between the financial crisis and COVID, right? That period of much lower inflation. That was the case for most people, unless you're putting your kids through college or you had big medical expenses,
Yeah.
or sorry, long-term care expenses, long-term care going in. Those have been skyrocketing for years. So your personal inflation, even if the official number was so low, your personal inflation, putting three kids through college or whatever, is much different. So I think I love your example, because that is a question we get a lot from people just trying to understand why their situation feels so different than the official numbers. Okay, final question here. Kind of consolidating these questions about when do you see the recession? What's the likelihood of recession? A lot of questions around recession.
Yeah,
So,
yeah, yeah. All right. So here's what I would say. I don't.
mhm,
And I don't think it's the right question. And here's the reason I say that. And I'm not trying to be flip. It's a good question,
mhm,
but we often think about the economic cycle as what inning are we in? And we define where we are right now because it's been such a long time since we've had a true official recession. Many people don't even think COVID really kind of fits as that traditional recession. That just felt like that was a hiccup. Um, a lot of people say, well, you're late cycle. Well, when you hear like your late cycle, they think, all right, you're in the seventh or eighth inning of this cycle. And so the end is near. And I think that's a fair way. That's what informs that question. And that's a fair way to think about it, except when I have 2% GDP and I have double digit earnings growth, as I said before, I don't want to pick a fight with that because that will always push the finish line way out. And so maybe we're in the sixth or the seventh inning, but what I don't believe is that the game ends in the ninth inning. I think this as long as I can score runs, this thing keeps going. And so what I would say is don't resist the temptation to feel like the end is near just because it's an old, well-established, mature economic cycle. This can stay this way for years and years and years. And some of the best money, as you're seeing right now, is made in these late innings. And so, the year before the dot-com crash, the NASDAQ was up 101%. And the year before that, it was up 95%. And so I'd say the greatest risk we have as investors is getting out too soon because you never get back in, and some of the highest returns happen in those late innings. So what I would say is I don't feel like a recession is imminent. Um, and that's because I feel good about the economy and I feel really good about corporate earnings. If we lose containment and we don't get the Strait of Hormuz opened, I think you get global recessions in other countries. And if that went on for 8, 9 months, then maybe we kind of get pulled into that. But just as an investor, just don't think about a finish line right now. You don't need to see the finish line to make good investment decisions.
thank you. And another thing I would add to that would be, we're watching very closely. And there's three major different things that can cause a recession: um, excess in the system, the bubble, a sudden shock event. Those are the two most common. There's other things too, but I'm just kind of throwing those out there. So, for example, the recession in '08 was easy to see coming. The data was showing us well in advance that we were in a recession. Maybe not knowing the full financial crisis and the severity of it, but we knew that we were heading there down, and there's opportunities to make adjustments. But to jump in just because the world seems, or to jump out, I should say, because the world seems crazy, or because it's been going on for a long time, or because all this news is scary, you do miss this. And the most critically important thing for the majority of investors is that you have enough money to meet your goals, objectives, and needs. And that's one of those things where you want to get that growth. So when it is time to pull in and be more conservative, you can also wait that out because time keeps marching on. And something really important that John mentioned is how often people jump out because the wrong politician's in office, because the news is scary, because of their brother-in-law told them to. There are a lot of reasons drive people out, and getting out of the markets is easier than getting in. Because once you get out, it's almost going to take everything perfect for a long period of time before you're ready to put your toe back in. But you've lost that too. So
Yeah,
it's
for sure.
important. But the final thing I will add to that is every investor is different. Everyone's time horizon is different. Everyone's comfort level with risk is different. Not everybody should be all in making money because we're in this stage of the economic cycle, because it depends on that. The most important thing is the money's there when you need it. So it's really, really important not to follow what some talking heads telling you, and I'm saying that as talking heads, haha, because we're not telling you what to do. We're talking about the economy. You notice none of us told you how to invest because each and every one of you is going to have different. Because the most important thing is the money's there when you need it, and it could be prudent to be more conservative. It could be prudent to be more moderate. It could be prudent to be completely out or completely in, depending on your individual situation. That is the most important thing. On a higher level, what we're watching, and again, John and his team at Goldman are a really important part of the information that we use as we're doing this, but the data is constantly changing, and we stay on top of that. We say, okay, where are we in the cycle, and what changes do we need to make on the individual levels? And that is the most important thing. So I do want to stress, if the news seems concerning, if you're uncertain about something in your own personal financial life, job loss, illness, anything going on, as well as in the broader economy or things you've heard, anything, always reach out to us, always ask questions, schedule a time to talk it through your specific situation. Because I mentioned, the most important thing is this money's here when you need it, so you can achieve all of the things that are most important to you. That's what this is all about. And that being said, in California, it is an election day, so hopefully you all got out, either mailed in your ballots or got out to vote or are getting out to vote. I actually always find the elections to be a fun and exciting time. There's something very special about the ability to vote. I don't know what it is about me. Maybe I'm just corny. I actually like to go in person and do it. That being said, and we'll see how this plays out. We'll talk a little bit, about any things we want to consider economically or otherwise as we get through not only the primary season, but also the midterms as well. And keep your questions coming. Anytime questions come up, let us know. If John, is this slide going to be available? Are we able to share any of this with?
Yeah, we can. I do need to drop, and so I'll let
Yeah,
you wrap
well, I'm
up
going
with
to
your
end this
clients.
now. I was just wanted to make sure. So if anyone saw anything on the slides that are interesting and want a copy, just let us know. I just need to confirm that was okay first. Thank you all for attending. We're at the end of this webinar, and any follow-up questions, just let us know. Have a great day.
See you, everyone. Take care.
Bye, John.